Baidu, which is similar to Alphabet here in the United States, but mostly primarily operates in China, has a search engine business where it generates revenue from advertising. It has an AI and cloud services segment. In fact, it's made recent breakthroughs in large language models and artificial intelligence. And it even has an autonomous driving driverless car technology segment. So it's really one of the leading tech firms in China, and in this video, I'm going to evaluate its business looking at revenue growth over recent years, profit, cash flow, and then looking at valuation to answer if this is an interesting AI stock for investors to buy at current valuations. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So Baidu, like Alibaba, has struggled to generate revenue growth in the recent several years. You can see revenue peaked at around $19 billion in 2022 and has been flat to declining since then, reaching $18.5 billion in the most recent trailing 12-month period. The Chinese economy has not recovered from the pandemic era shutdowns, and then adding further discomfort to that economy have been tariffs placed on China from the United States, one of its primary trading partners. This hasn't been good news for the local economy, but also businesses that export. And then the sentiment among people in China has turned sour as those prospects have weakened. They've begun to save more money, spending less, staying home more often. And that's just been a headwind that's persisting even throughout the government's appeals and the government's attempts to try and spur growth in the region. And so partly due to the declining revenue and partly due to the investments in research and development, developing these large language models, spending on the data centers for the computing capacity to develop artificial intelligence, etc. All of this is weighing on the company's cash flow from operations, which fell to $3 billion in the most recent trailing 12-month period. That's down from around $5 billion at peak levels just over a year ago. Now, they have turned this around. The declines have reversed, and in the most recent quarter, the company's profit increased year over year. In fact, Baidu's net profit doubled year over year in the most recent quarter. Still, investors are concerned about its prospects, even though they're pleased with the latest developments with its Ernie X1 and Ernie 4.5. They're two new AI models that are supposedly better cost per performance compared to DeepSeek. And remember, DeepSeek was a major cost improvement from large language models like ChatGPT and Google's Gemini. So lots of development here in the region, creating large language models, creating artificial intelligence on a budget because of the restrictions that Chinese firms face buying chips from the United States. NVIDIA has severe restrictions on which one of its chips it can sell to Chinese companies. And so these companies have had to innovate, have had to adapt and find other ways to create these large language models. And they're doing a relatively good job from the early news that's coming out from the region. Now, it's still very early days in this AI market, and it remains to be seen how effective these models are versus the models from the United States, including ChatGPT. And then, of course, you have the risks stemming from the fact that they're Chinese-owned firms and the question marks surrounding how much of the data is being shared with the Chinese government, and if businesses cannot trust the security of the data, will they be willing to adapt the technology as much as maybe another technology that doesn't have those question marks? So, again, a lot of things that these companies need to answer, and time will tell where these restrictions and developments lead. So, the returns on investor capital have also been declining. If you look back in the last decade, they were generating returns on investor capital above 30%, which is really strong. And that dipped all the way to negative numbers in 2022. Since then, it's recovering to 7%, but it's still down from the recent highs. Well, I shouldn't say recent highs, but from the all-time highs reached about 6, 7, 8 years ago. So there's been a lot of pressure on these companies. Growth has slowed down, which has hurt profitability because spending has persisted and returns on investor capital are just about neutral. I would say that they're barely and they're perhaps below the company's cost of capital. And if they uh, recover these back to double digit ranges, that could be good news for the company. The big question mark is the macroeconomic picture in China. If the macroeconomic picture improves back to the levels of growth before, let's say, 2017, 2018, when the impacts of the first rounds of tariffs from Donald Trump's first term started to take effect, then these companies will benefit from that growth. However, if growth remains muted and we haven't yet seen the full impacts on the Chinese economy from the additional 20% in tariffs that President Donald Trump placed on China and once he took office in January, placed tariffs in February, then added another 10% a month ago. And so those are going to reverberate throughout the Chinese economy. And already consumers in that region are pulling back spending and getting ready for tougher times ahead as businesses and manufacturers shift manufacturing outside of China so that they can avoid these tariffs. And that's going to cost a lot of jobs to leave that region. And the population is massive. So if there isn't growth in the manufacturing base, there's going to be lots of unemployment. And the safety net is not as strong in China as it is here in the United States. So consumers really have to save up to protect themselves in tough times because they don't have the features that the United States has, where if you're unemployed, you get unemployment insurance, you get food benefits, you get medical benefits, and the country protects you a little bit more here in tough times than in China, where consumers have to build up and save up to protect themselves in those tough moments. So, looking at valuation, Baidu on a forward price to earnings ratio is trading at 8.7 and on a price to free cash flow basis at 11.6. So this is cheap for this kind of a business, right? When you're talking about an AI business, developing large language models, operating in the advertising industry, typically these kinds of businesses would trade at higher valuations, but they haven't been, right? And one of its peers, Alibaba, also trades at a similarly low valuation because of all of those headwinds I talked about earlier. So in the near term, I expect pressure to continue. But longer term, I think the innovative nature of this business means that it's worth taking a shot here. The risk versus reward is worthwhile for long-term investors. So to answer the question, is this stock a buy here at current valuations? I would say yes. And I'm updating that here today, March 19, 2025. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.